Stop what you're doing. If you own sports stocks, or even if you've just thought about buying a piece of your favorite team, you absolutely need to hear this fundamental breakdown. Look, I completely understand the common fear retail investors have, right? Buying into a sports franchise usually feels like buying a massively expensive vanity project that just bleeds cash. You think you're buying the logo, not a logical, profitable balance sheet. Well, last week, I ran Atlanta Braves holdings through 5 different valuation models and 2 legendary checklists, and honestly, what I found shocked me.
What if I told you this stock's intrinsic value might be completely misunderstood by the market because Atlanta Braves Holdings just dropped a Q1 2026 earnings report and they posted a staggering 53% surge in top-line revenue? 53%. That is a gigantic year-over-year jump for a single quarter, driven by some major structural shifts in how this team actually does business.
But here is where we hit that shocking, contrarian reality of professional sports finance. You've got this incredible $72 million rolling in on the top line, yet the company still posted a crushing $40.5 million net loss for that exact same quarter. It really makes you wonder what Warren Buffett or Peter Lynch would think looking at this cash bleed, right? Would they see a deeply hidden economic moat or just a financial black hole?
Which brings us to the ultimate question for today's explainer. Is this franchise a financial home run, cleverly disguised as a real estate empire? Or is it a massive $254 million payroll trap waiting to spring on unsuspecting investors? By the end of this explainer, you're going to know exactly if Bayard TNK is a Buffett buy or a Lynch trap. I'm going to give you a clear, actionable framework to evaluate the true intrinsic value of the Braves, taking us way past the fandom and deep into the actual numbers.
Section 1. The Disguised Real Estate Empire. Okay, let's dive into this, because to truly understand the modern Atlanta Braves, you have to stop looking at them as just a baseball team. It's like a giant puzzle, and the team is only one piece of it. You are actually looking at a highly leveraged, disguised real estate empire. Out of that $72 million in Q1 revenue, $45.7 million came from baseball operations. But check out that second slice, $26.2 million, which is up 41% from last year, by the way, came purely from their mixed-use development segment. We're talking about the BATRA Atlanta and the newly acquired Pennant Park assets. This means the Braves are pulling in tens of millions in commercial rental income and tenant recoveries before a single pitch is even thrown. It's beautiful, year-round passive revenue.
And this brilliantly illustrates exactly why the baseball side alone saw a 60% revenue jump. First off, the calendar was just in their favor. They hosted 5 regular season home games in Q1 of 2026, compared to literally 0 in Q1 of 2025. Plus, they launched Braves Vision, which means they're taking direct control of their own local multimedia rights. Huge move. And finally, the fans are actually showing up. According to Baseball Reference data, they pulled in over 1 million total fans, averaging nearly 34,700 people per game. So you've got more games, more owned media, more tickets, and crucially, a lot more foot traffic for all that real estate.
Section 2. The $250 million payroll.
Here's the catch, though. Keeping those 34,000 daily fans in their seats, it requires a massive, ongoing investment. So let's pivot from the revenue engine to the primary anchor weighing down the costs. $254 million. That's the estimated 2026 player payroll that's just dragging on their operating income. When you have this massive top-line number, but you're still reporting a $40 million quarterly net loss, well, this right here is where the cash is bleeding out. Fielding a highly competitive, championship-caliber baseball team is frankly just exceptionally expensive.
Now, what's really interesting about this is the structure of these fixed costs. You've got top guaranteed salaries for 2026. Guys like Austin Riley making $21.2 million, Matt Olson at $21 million, Ha-Seong Kim at $20 million, and Chris Sale at $18 million. And the absolutely crucial thing for investors to understand here is that many of these are locked-in, multi-year contracts stretching all the way into the 2030s. Unlike a traditional tech company or a retailer that can just lay off staff during a downturn to save cash, a sports franchise's labor costs are almost entirely fixed. They are fully guaranteed, regardless of whether the team wins the World Series or finishes dead last.
Section 3. Under the financial hood. So, we've got soaring revenues paired with these incredibly heavy fixed labor costs. Let's lift the hood and look at the fundamental balance sheet data provided by Morningstar to see how the company actually handles all this weight. First, the good news for the equity standing. As of the end of Q1 2026, the Braves hold $1.69 billion in total assets, compared to $1.16 billion in total liabilities. To put that simply, the physical assets, the stadium, the prime real estate around it, the brand value itself, heavily outweigh what they owe. Their book value is solidly positive.
But we absolutely have to talk about the leverage required to run this whole mixed-use empire. Their total debt sits at a pretty staggering $810 million. Building out a massive entertainment district and locking down top-tier talent requires serious capital, and the Braves are heavily leveraged to make all that happen. This huge debt load is a major reason why that operational growth doesn't immediately translate to positive net earnings per share for you as an investor.
However, before you panic, despite that heavy debt and despite the $40.5 million net loss for the quarter, the balance sheet does show strong liquidity. They are sitting on $135.2 million in cash and cash equivalents. This provides a really comfortable buffer. It reassures us that they actually have the cash flow on hand right now to service that debt, pay those massive player salaries, and easily weather the seasonal ups and downs of the sport.
Section 4. Is BATRK a buy? So, the crucial point is, how do we synthesize all of this into one clear takeaway? When you strip away the baseball caps, the hot dogs, and the pennants, what's the fundamental verdict on Atlanta Braves holdings? Well, here is the impartial summary straight from the data. On the bull side, you've got incredible momentum. We're talking a 53% surge in revenue, the successful launch of their owned media platform, Braves Vision, and an absolute cash cow of a real estate asset in the BATRA Atlanta, providing that sweet, passive, year-round income. But on the bear side, you are buying into a heavily leveraged company carrying $810 million in debt with a business model permanently anchored to a $250 million fully guaranteed labor payroll that actively drags down their quarterly net income.
Which leaves us with this final provocative thought. As an investor, you really have to ask yourself, does the emotional dividend, the sheer thrill of owning a piece of a legendary sports franchise and a premier entertainment district, does that actually outweigh the harsh reality of a $40 million quarterly loss and massive fixed roster costs? It's a fascinating look at the true economics of sports ownership. Thanks for joining me on this explainer, and remember, always keep questioning the numbers behind the game.